If you've been tracking the streaming space or really any high-growth tech stocks, you've definitely seen the noise around FuboTV. Ticker is FUBO.
Oh, absolutely. It's become a real lightning rod.
Right. Just intense fear, a lot of heavy selling, and the stock price has just been hammered by the recent news.
But that's the paradox, isn't it? According to some corners of Wall Street, that very volatility, that panic, it's created what they see as a huge asymmetric opportunity.
And that's what we're digging into. The market noise has been, deafening. It's all anxiety and a really ugly-looking chart.
So our mission for this deep dive is to cut through that. We're going to unpack a detailed analysis that focuses only on the bullish thesis.
We need to understand why. Why do professional analysts think the bad news is overblown? And, why are they sticking to some surprisingly high price targets?
And those targets are really what make this so interesting.
They really are. Right now, the stock's hovering around, what, $2.68?
Just about.
Yet the research we're analyzing points to an average analyst target of $4.50. Some are even higher.
That's a potential 67% upside. It really makes this whole valuation debate fascinating.
And the goal for you listening is to understand the core logic here. Why are some market veterans looking right past this current crisis?
And treating this moment as a potential golden entry for, say, 2026. To answer that, we have to start with the one financial metric that these bulls are staking their whole argument on.
The valuation disconnect.
Exactly.
Okay, so let's unpack this setup, because it's really a story of fear creating a numerical anomaly.
It is. The stock fell hard.
It slid from well over 350 down to where it is now. And we know the trigger. It was that very public carriage dispute, the blackout of the NBC Universal channels.
That's what made the chart so ugly. The fear was absolutely real, and it created this chasm.
So when we analyze these high-growth stocks, we're not really looking at earnings, right? We're focused on top-line revenue.
That's right. And that means we use the price-to-sales ratio, the PS ratio. And according to the analysts backing this bull thesis, that is the single most compelling data point for Fubo right now.
Okay, so let's just clarify that for everyone, because it's the backbone of this whole argument.
Please.
It's just the market value of the company divided by its total annual revenue. It tells you how much you're paying for every dollar of sales. And the number they cite is, well, it's eye-opening. FUBO is trading at a PS of about 0.62.
0.62.
Yeah.
To put that in perspective, for every single dollar of revenue Fubo generates, the market is only giving it 62 cents of valuation.
And that's based on some hard numbers from the research.
Concrete numbers. The company is on track to generate $1.62 billion in annual revenue, but its market cap is only around $918 million.
Okay, I have to jump in here with some skepticism. Valued at roughly half its revenue. For a tech company in the streaming space, that sounds less like an opportunity and more like, a massive red flag.
That's the right question to ask. That's exactly where the tension is.
It points to cash burn, right? Even before the dispute.
The research acknowledges the cash burn, for sure, but it argues pretty forcefully that the scale of this disconnect is just irrational.
How so?
As the report points out, for most streaming and growth tech stocks, anything under a 1.0 times sales is already considered distressed territory.
That's for companies where revenue is actually shrinking or bankruptcy is a real threat.
Exactly. So the core argument is that the market is pricing Fubo as if its $1.6 billion revenue stream is just about to evaporate.
Which their own growth figures just don't support.
Precisely. The research argues this kind of deep value pricing is just fundamentally inconsistent with a company that's still growing its top line. The bulls believe the fear has driven the price so low that it's now technically undervalued, no matter what the headlines say.
But that huge valuation disconnect only exists because of that one specific anxiety.
The carriage dispute itself.
Right. We can't analyze this without really diving into the elephant in the room, the loss of that NBC Universal content.
And we have to acknowledge the impact. This wasn't just some small channel.
No, it was big. Fubo dropped 18 regional sports networks, plus channels like USA Network and Sapphire.
All crucial for their core audience of sports fans and, general entertainment viewers. In the short term, losing those channels is catastrophic. It's why the stock dropped so violently.
But the contrarian view, the one this analysis is all about, is that the drop was so severe it became self-correcting.
Yes. The thesis is that the stock fell so far, so fast, that the absolute worst-case scenario is now already priced in at this low point, around 260.
So anyone who panicked and wanted to sell, they've already done it.
The sellers are exhausted, and that sets the stage for a rebound if, and it's a big if, a couple of specific catalysts happen.
So what are those triggers? What makes that fear premium just evaporate and start pushing the stock back toward that 450 target?
Well, the first one is obvious, but it's hard to predict. A resolution to the dispute.
Even a partial deal, right?
Oh, even a partial deal. If they brought back just the key regional sports networks, that would cause an immediate, powerful rally.
And the second catalyst?
A second one is much more tangible, and it's completely within Fubo's control. It's all about subscriber retention.
Tell us more about that. What's the retention strategy? They can't just be crossing their fingers.
Not at all. They're being very aggressive with targeted pricing to minimize the churn.
So they're cutting prices?
On their Pro and Elite plans, yes. Aggressive cuts. They're basically trying to compensate users for the lost channels with cost savings.
And if that works?
If the retention rate holds up, let's say they only lose 5% of their subscribers instead of the 20% the market fears. Then the market realizes that core revenue stream, that $1.62 billion figure, is basically intact.
And that changes the whole narrative.
It changes it from existential crisis to temporary headwind.
I get the logic, but isn't that a huge bet? Relying on price cuts, you're reducing your revenue per user to keep the overall number stable.
You are.
It sounds like trading short-term margin for long-term survival.
And that's the risk. That's why the report summary is literally high risk, massive reward.
Yeah.
The analysis argues that if their ad tech stack can monetize that retained audience at a higher rate, it'll minimize the sting from the price cuts. But yes, the success of that retention effort is the critical variable.
Which leads us perfectly into the institutional perspective. Let's move past the short-term fight. What do the long-term professionals think about Fubo's underlying viability?
The institutional confidence is really the counterweight to all this market anxiety. The consensus rating for the stock across the board is still a strong buy or outperform.
They're looking years down the line, not just at the next quarter.
Exactly. And their conviction is backed by those hard numbers. We know the average target is 450. That's the 67% upside.
Right.
But it's also worth noting the high watermark in the research. Some firms have targets as high as $5.25.
Which is, that's almost a 2x return.
A two-bagger, as they call it in trading circles. You could potentially double your investment if that high target is hit.
So why are some analysts so much more bullish? Targeting 525 when the average is 450? What are they assuming about Fubo's future?
Those higher targets assume perfect execution on three core underlying assets. They believe these assets alone are worth more than the entire company's current market cap.
Okay, let's break those down.
First is Fubo's proprietary technologies. This isn't just another streaming platform.
Right.
They've developed patented tech around their UI, specifically for live sports. Things like multi-view streams, integrated data overlays. It gives them a competitive moat.
And the second asset, sports wagering integration. That sounds like a massive long-term play.
It's the ultimate differentiator. The research suggests Fubo is perfectly positioned to integrate sports betting right into the viewing experience.
So you could watch a game and place a bet without ever leaving the app.
Imagine that, a watch and wager model. If they execute that, they unlock a huge slice of the U.S. online sports betting market. The 525 targets assume that becomes a major high-margin revenue driver by 2026.
And finally, the ad tech stack. How does that fit in?
The ad tech stack lets them monetize their audience way more effectively than traditional TV. They can target ads based on who you are and what you watch.
Which makes their ad space much more valuable.
Significantly. The analysis really emphasizes that in the streaming wars, high-yield ad revenue is the key to minimizing that cash burn we talked about. Their $1.6 billion revenue base is so valuable because of their ability to monetize it through this tech.
Okay, that completes the fundamental picture. But for you, the learner, the entry point is everything. So let's shift to the short-term trading dynamics, the technical levels that often dictate where the big money buys.
The technical setup here provides a really clear framework. The report emphasizes one crucial support level. They call it the absolute line in the sand.
And that level is?
$2.60.
Why 260? What's the history there?
It's not arbitrary. The technicals show that 260 was a major institutional accumulation zone last year. It was a multi-year low where large funds kept stepping in.
And the stock bounced right off it this time.
Exactly. It dipped precisely to 260 during the panic and immediately bounced instead of crashing through. That suggests confident institutional money is still waiting there, acting as a floor.
So 260 is the support floor the bulls have to defend. If we're sitting just above it, what's the immediate hurdle to clear for momentum to start building?
The immediate resistance is a very narrow band, between 275 and 280.
Okay.
That's the zone where sellers who bought right before the NBCU news are trying to get out at break even. It's a natural technical barrier.
So if the floor is 260 and the ceiling is 280, what's the specific trigger that signals the momentum has finally shifted from selling to buying?
The analysis report is very precise on this. The trigger is if the stock clears 280 on significant volume.
Volume is the key.
Volume is the confirmation. When you see volume with that break, it signals the supply of panicked sellers has been absorbed. And once that resistance is broken with conviction, the analysis suggests the rapid price correction, the gap fill back toward $3 begins.
So breaking 280 is the starting gun.
It's the signal that the market is finally starting to reconcile that valuation disconnect.
That is a really comprehensive breakdown. You've got the extreme valuation metrics on one side and the short-term technical map on the other.
And it's clear the whole bullish thesis relies on the market eventually figuring out the difference between a temporary crisis and a structural failure.
Right.
If we synthesize all this, the tension is just so clear. You have an irrational fear driving the stock into deep value territory, but that's contradicted by huge annual revenues and these compelling underlying assets. The report summarizes it perfectly. High risk, massive reward.
And the ultimate finding of this deep dive is that the $1.6 billion plus annual revenue figure is the fundamental anchor. The analysts argue that number just doesn't justify a stock price that stays under $3 forever.
No matter how bad the short-term news is, the market has to eventually reconcile the fact that a high-growth company generating that much revenue can't logically trade at half its sales forever, especially if they pull off that retention strategy.
So we'll leave you with this final provocative thought to consider. The core argument for that 450 target rests on that irrational PS ratio of 0.62. To mathematically justify a 67% jump in valuation, what specific reduction in cash burn or what precise percentage of increased ad revenue per user must happen alongside that subscriber retention to actually validate the bullish case? The answer requires looking deeper than just keeping the customers. It's about finding the path to profitability that justifies that much higher market cap.